Good morning and welcome, ladies and gentlemen, to this IEA IEA SIP event, the presentation of the new gas quarterly report by the IEA. These are extremely interesting, of course, disquieting times for energy markets as well. It is very timely, I think, that we have this meeting now to get a much needed update from our colleagues and friends at the IEA, Jean-Baptiste Dubreuil, Senior Gas Analyst, and Gergelin Molnar, Gas Analyst. As per tradition, I'm joined here today by Kobe van der Linde, Director of the Klingendael International Energy Program. In the last few weeks, gas markets have witnessed major volatility. Actually, this is part of a trend, unfortunately, of extremely important volatility in the last couple of years. We have had record low prices in 2020, record high prices already in 2021 before Russia's invasion of Ukraine, and then since the 24th of February, the situation has deteriorated even further with even additional volatility and higher price spikes. It is, however, important to highlight that European natural gas supply has been a topic of concern already in 2021. We were seeing storage levels being very low, well below average, mainly due to the fact that Gazprom was not filling its storages in the EU. In the following months, we have been observing this race to the ceiling between Europe and Asia that have been competing to attract volumes of flexible LNG. We have had structurally higher prices in the last few months, but as I said, also a lot of fluctuations with price spikes triggered sometimes by events, but sometimes by announcements. So actually, I think one thing that we've seen in the last few weeks and months is that expectations of market players can be a very important driver for hub prices. We've had spikes when Gazprom announced that they would exit Gazprom Germania. We've had spikes when there was the announcement that Russia was requiring its buyers to pay in rubles, especially at the beginning when it was very unclear how the mechanism would be designed. Then it became clear that the mechanism was one of indirect payment, so that partially changed things, and especially the perception of how this transition to ruble payment would impact physical flows. So far, we've had record high prices without real interruptions of flows. And actually, as you all know, nowadays there is a debate in Europe on whether to impose an embargo on Russian gas imports. At the same time, I'm sure there are discussions in Russia on whether it would be strategic to interrupt supplies to Europe. So we've seen high prices without physical interruption of flows. So we can only imagine what might happen if an interruption actually takes place. We know that in the EU, the discussion is ongoing, and many countries are in favor, but some countries are against, notably Germany, Hungary, and a few others. Coal has been included in the last package of sanctions, so breaking the taboo of embargoing energy imports, but neither oil nor gas has to date been included in the sanction packages. The European Commission is drafting a plan to drastically reduce its dependency on Russian gas. We have had a communication in March called Repower EU, which is, let's say, the first stepping stone towards the publication of a Repower EU plan, which is expected for 18th of May. In the communication from March, the European Commission expresses the aim to cut Russian imports by 2/3, 100 BCM by the end of 2022. This looks, of course, extremely challenging, especially if we look at the breakdown of how much Russian gas could be saved through single measures. So the Commission expects 50 BCM of additional LNG imports in 2022. The IEA, for example, expects 20. We will hear more probably from both Jean-Baptiste and Gergely about the 10-point plan from the IEA that actually came before the communication by the European Commission. Again, the European Commission expects 10 additional BCM coming from pipeline suppliers, 14 BCM of avoided Russian gas through energy efficiency, 10 BCM just by reducing the heating by 1 degree, but also 20 BCM of savings through a faster deployment of renewables. Now, the European Commission and member states are scrutinizing other options, more precise tools on how to achieve these goals. There's quite a lot of disagreement. I have to say there are measures that are on the table that are potentially very disruptive. So physical disruption of Russian flows is not the only disruptive thing to watch for in the next months. There are calls to introduce joint procurement schemes, but then it's quite unclear who would negotiate the contracts. There are calls to introduce caps on gas prices, but then, of course, the ramifications on market functioning are quite hard to forecast. At the same time, it's clear that something needs to be done. When discussing an embargo, I think the main concern on the one hand is that the transfer of money to Russia is becoming more and more politically unacceptable. We are seeing figures of 25 billion euros having gone to Russia for its energy. So it's not only gas, it's energy in general in the last month. At the same time, of course, there are indications and estimates that an embargo on Russian energy and gas in particular would trigger a recession. We have read, FT articles saying this about Germany, and we would have a recession after very difficult years for the economy due to COVID, and in a context where national governments are pumping a lot of money into the real economy, something that is contributing to inflation, which is also rooted in other factors. So, of course, it is very concerning if we look ahead to think about a conjuncture in which we have negative GDP growth and very high inflation. So it's a very, very delicate situation, the one we are in. Something has already been done in the last few weeks. There has been a new regulation on storage filling, I think quite sensible by the European Commission, obliging to fill storages at least 80% for 2022. Once again, there are challenges because, of course, filling storage is a very expensive undertaking at the moment. So incentives need to be in place to convince operators to do that. And we see that in some countries, it's not going as smoothly as foreseen. There has been a very clear push, a very clear drive towards accelerating the installation of renewable capacity. Very good. But then once again, we need to see to what extent changes in legislation, such as the declaration of renewable projects as projects of overriding national interest, which we are starting to see in some EU legislation, will have a concrete effect in terms of accelerating deployment. And finally, I think something that we really need to start studying are the long-term consequences of choosing being made today where we are in a crisis, in a situation of crisis, in a situation of emergency, because some of the measures discussed are really transformative for the gas market. It's going to be very interesting also to observe and to study, to analyze what's going to happen to gas demand, in the longer term as a result of the crisis of today. So to answer these and many other questions, we now have our two friends and colleagues from the IEA, Jean-Baptiste and Gergely, that will present the new IEA gas quarterly report. And their presentations will be followed, as I said, by a Q&A session. So once again, for those of you who logged in later, we are now at 133 participants. Please feel free to already post your questions in the Q&A box. So without further ado, I would like to leave the floor to the IEA for their presentation. Thank you very much.
Thanks a lot. Good morning, everyone. A great big thanks, as usual, to our friends and colleagues, Luca and Kobe, for hosting us again, for CP and IEA for organizing this discussion. So, as usual, we'll be handling the presentation, two of us, Gege and myself. And before going to the European situation, which is, as Luca rightly pointed, at the epicenter of the current gas crisis, I'd like to give you a bit of a global overview and looking at the different regional components before focusing into the European situation. This is the situation as we speak today. Of course, as you can see, we have plotted there the three main indices. So you have the Asian spot LNG price in red, the light blue is Europe's TTF, and the dark blue is the US Henry Hub. Europe has been leading the dance for quite some time, and for those who are familiar with those quarterly webinars, this is something that we've been noting for a couple of times already. This trend to very high level and very high volatility of prices is not something new, but it has been further exacerbated by the invasion of Ukraine end of February. As you can see on the graph, the black dotted line shows the first day of the invasion. And since then, we have experienced new records, both in terms of price levels and price volatility, especially at the beginning of March. And we're still going through there. Europe's been leading the gas price moves. It is certainly the case when we talk about the evolution of LNG spot prices. And as you can see, there's a very strong correlation in terms of moves in between the European and the Asian marginal price for LNG. It also has some repercussions beyond Europe. I'd like to go a bit further into the details for non-European markets. Briefly looking at the Asian situation. So you find again the short-term LNG spot index, which is the yellow line on top. As you can see, again, this is not something new. This upward trend has been ongoing since summer of 2021. And we've had, of course, further rises since the Russian invasion of Ukraine in February, with a very strong uptick in short-term LNG spot prices, but also strong drive in other Asian major price indices, whether it be in importing markets such as India. You have in red the IGX, which is the Indian gas exchange price, which is slightly lower than the JKM spot index, but it is still very strongly impacted by the rise in LNG prices. And even in LNG exporting markets, at the bottom, the blue line, which is the Australian Northeast price, you can see that it is, even if, of course, it is well below other indices, it has been growing as a trend over the past 6-9 months. Another interesting perspective to look at is what happens also in a major producing and exporting country, which is the United States. So, of course, in terms of absolute price levels, US prices, nothing to compare with what we're seeing in Europe, what we're seeing in Asia and other importing gas markets. But there is clearly an upward trend, and this upward trend has been increasing since the beginning of the invasion. You can see there the evolution of US Henry Hub spot prices for the past year, and we've had the usual increase over the beginning of the winter months, and since end of February, this is clearly an upward trend, and we've seen the beginning of this week. And we had prices going above, on the month ahead, above $8 per MMBTU, which is its highest level seen since the beginning of the rollout of the shale gas back in 2008. Of course, there's not a direct link with the crisis and the situation with Russian gas in Europe, but there's a combination of factors that has led to this tightening. We were observing late, colder than average temperatures in the US, which have sustained residential commercial consumption in March and beginning of April, which has also led to lower than average storage inventory in the US, higher dependence on Canadian pipeline gas imports, and of course, there's the ever-growing role of LNG exports, the US being the leading source of growth for LNG over the past months to sustain the LNG balance in those troubled and tight market conditions. So, of course, again, Europe stays at the epicenter of the situation, but this is having global repercussions on the different markets, the different regions. Looking a bit quickly at what happened over the past season and the past year. So last year, we've had a very strong sustained growth, 4.5%, according to our estimates. But this was really a year, 2 halves. We've had first half of the year, as you can see on the left-hand side figure, first half of the year, a very strong recovery because of the difference from 2020's lockdowns, with over 8% increase year on year in Q2. In regions which were strongly affected by the lockdown, such as Europe, we had double-digit growth rates. But very quickly, this recovery waned, and we had a very steep decline in the growth rate, around 3% in Q3, and about 1% in Q4. And this is really having its consequence from the rising price environment that I was just showing before. Very interesting metric to follow that we track very, very closely is the evolution of gas demand in those particularly price-sensitive segments, such as industry demand. This is what you have on the right. This is the monthly evolution year on year and gas consumption by industrial customers in the basket of main markets. You see, you have the United States, China, Western Europe, and India. There's clearly this evolution of towards strong growth in the first half of 2021 to slow growth and negative growth compared to the previous year in the second half of the year. And when we move on to 2022, this negative growth is still going on. We have one exception with the United States, which had seen some positive growth in Q1, and there was one-off in China in February. But apart from that, we're definitely seeing the impact of the tightening of the market and of the high price environment. Of course, another factor that we are closely monitoring that you can find in the report is fuel switching and power generation. We've seen this happening both in the US and in Europe. In the US, gas prices have limited the attractiveness of natural gas for power generation, but over the winter there also has been some constraints in terms of coal supply, which has has had the effect of increasing the share of gas in power generation in spite of those high prices. But it really has to do with the practical issues of coal supply sourcing. So before we move to that European focus, one last thing I wanted to mention on the situation, the global situation, is the role of LNG. This is something, those who are familiar with our reports, is something that we regularly highlight in our publication. LNG being both a source of diversification of supply, but also a strong source of flexibility to the whole system. And of course, what we're seeing and what we've seen in the past month, it makes no exception to that rule. We've had a very strong role played by LNG, both in terms of ramping up new volumes and in terms of offering flexibility to the different markets. So looking at the evolution since the beginning of 2021, you see on this slide, you have the evolution, monthly evolution of global LNG trade, which is the black line. You see a very strong increase in between August and January, second half of 2021, ramping up to help delivering additional volumes to the market. The other component is where those additional cargoes have been going. And the different slices on the figure show you the respective market shares of the different markets. So at the bottom, you have the different Asian buyers. Europe is in the middle in yellow, and on the top, you have the other markets. So we've moved from an initial situation beginning of 2021 when we had the traditional overdominance of Asia. Europe was accounting for about 12% in January. In the middle of 2021, we've had this very tight summer market, which I would rather say southern winter market, which was mainly caused by the exceptional draft situation in Latin America. As you can see, the red wedge on the top, which is increasing with the share of Central and South America, which has been putting pressure on the market during the northern summer months. And as from September and on to today, the share of Europe has been expanding. This has been made possible on the one hand by relaxation of the tightness in South America, with hydro reservoirs filling up progressively, and also milder than expected winter conditions in Northeast Asia, which has helped to reduce the pressure in terms of delivery for those markets and enable additional volumes coming to Europe. As you can see on the Asian side, it's not so much the traditional buyers that have seen a decline, but surprisingly, new buyers, in particularly China, which is the dark green wedge just below Europe, which has seen its share slightly decline since the beginning of the year to the benefit of Europe. So I would like now to give the floor to my colleague Gergely, who will give you a bit more detail into the European situation before we go back to the global analysis and consequences of the current situation. Thanks. Gergely, the floor is yours.
Thank you, Jean-Baptiste. My name is Gergely Molnár. I'm a gas analyst within the Gas, Coal and Power Markets Division of the International Energy Agency. And first of all, would like to thank you, our hosts, Kobe and Luca, for having us today. It has become a really nice tradition to present our quarterly gas report in this very nice setup. As mentioned by Jean-Baptiste, Europe has been really at the epicenter of all the market turmoil which has been taking place in the last couple of months and which has been intensified since Russia's brutal invasion of Ukraine. So in the next couple of minutes, we would like to focus a bit more on this European market. First, we will provide an overview of the market dynamics during the heating season, and then we will present our short-term forecast for this year. So on this slide, we just presenting the main demand side dynamics of the European gas market during the heating season, which in Europe lasts from the beginning of October until the end of March. And our very first figures are indicating that European gas consumption has declined by approximately 4% year on year during this period. And this has been really driven on one hand by milder weather conditions, but also the record high gas prices weighing on gas demand in the power and industrial sectors. If you are looking at the first graph on this slide, it shows the estimated daily distribution network related demand, which is mainly used for space heating purposes in residential and commercial sectors, and as such is quite temperature sensitive. In contrast with the previous heating season, when Europe has faced several cold spells, this heating season weather was rather nice to us. We had several warm spells, and we had a particularly mild February, and also the first half of March has been quite mild. As a result, we estimate that distribution network related demand declined by approximately 5% during the heating season and collapsed by almost 10% in Q1 of this year. Moving to the second graph on this slide, which shows we show the evolution of power generation by source. And I think what is quite interesting is that despite the record high prices for natural gas, gas-fired generation has been rather resilient, and actually it increased by a mere 1% during the heating season. And this has been largely due to the lower hydropower output in the southern European markets, including Italy and Spain. In those markets, there is limited coal-fired generation, and as such, gas-fired power plants were the one which sort of made up for the shortfall in hydro generation. In other parts of Europe, including Northwest Europe, Central and Eastern Europe, we have seen a more substantial gas to coal switching with coal-fired generation up by over 15% and gas-fired generation down by 7%. But altogether, European gas-fired generation was slightly up compared to the previous heating season, according to our preliminary numbers. And the last graph shows the quarterly evolution of industrial gas demand in Europe. We see the steep year-on-year decline in the first half of 2020, when that was the time of the COVID lockdowns. Then a steep rebound when the lockdown measures have been softened or lifted. And we see that starting from the third quarter of 2021, industrial activity has been slowing down, and we entered into negative territory during the heating season, when altogether industrial demand has declined by approximately 6% year on year. But we see that the drop has been continuing and became more intense during the first quarter of 2022, when industrial gas demand have declined by around 8% year on year. And this is mainly driven to production curtailments, temporary shut-ins in the most gas and the most energy-intensive industries. So following the demand side, it is also interesting to look at how supply evolved in the heating season. And here I think that the most important point is really how Russia's piped gas supply evolved. It declined by approximately 25% year on year, or in absolute terms, by over 20 BCM. This is despite the fact that there have been supply and transport capacity available, and there have been a strong incentive to supply the European gas market, where gas prices have been surging to record levels. Despite this attractive market environment, Gazprom ceased short-term sales via its electronic sales platform since the beginning of October, and haven't restarted since then. Now, I think that when we are looking at other suppliers, the picture is quite different, because all of them has been increasing their supplies to the European market. Algeria has increased by over 10% its deliveries to the EU. But because of the non-availability of the Maghreb-Europe pipeline and the lower Libyan flows, altogether North African flows have slightly declined year on year. Norwegian pipeline deliveries to the rest of the continent has been up by 8% year on year, and the Norwegian exporting facilities have been running near to the nameplate capacity. And of course, the Trans-Adriatic pipeline had made a very nice contribution to the European supply picture, and has been running also close to its nameplate capacity during the heating season. But it has been really LNG which was making the heavy lifting in terms of additional supply. European LNG imports surged by approximately 55% year on year, and about 2/3 of this incremental LNG has been supplied by the United States, which solidified its position as Europe's largest LNG supplier, accounting for about 40% of Europe's LNG supplies. Now, looking at our short-term forecast, this graph shows how we see European gas demand evolving in this very particular market context. Altogether, we foresee that European gas consumption will decline by around 6%, or over 30 BCM in 2022, bringing down European gas demand basically to the COVID year, to 2020 levels. And we see on this slide the breakdown of by sector who is contributing to this decline. The first is, of course, residential and commercial sectors. This already includes the milder Q1 period, but it also assumes more or less average weather conditions for the rest of the year, which is in some way is in contrast with what we had in 2021, when we had a quite cold and long heating season extending into April and even into May in some parts of Europe. The second component of this decline is the power sector, where we foresee gas to power demand declining by approximately 5%. We foresee a stronger demand response from the power sector during the summer season, and we also foresee a stronger expansion of renewable power generation. The third major component is industry, where we foresee that industrial gas consumption will plummet back close to close to 2020 levels. So this just really, I think, highlights the huge impact of these very high gas prices on industrial activity. But one major component of gas demand, which should not be overlooked in the summer, is of course injections into the storage facilities. I would like to remind ourselves that we ended the heating season with storage levels about 8 BCM below their 5-year levels. And of course, I think both Luca and Jean-Baptiste mentioned the reason behind the very particular storage situation we are having here in Europe. But nevertheless, I think what is key to note here is that the European Commission has proposed a target to fill European storages up to 80% by the 1st of November of 2022. This would require, injections amounting to 54 BCM during the gas summer, which is about 6 BCM higher than the injections we had last year. Now, I think what is also quite important to note that a number of member countries have more ambitious targets than 80% and are leaning towards filling their storages up to 90%. And this includes Belgium, but also France, Germany, Italy, and Spain. So this is just to say that the injection demand, if those targets have to be met, could be even stronger than the 54 BCM I refer to. And this strong injection demand will, of course, increase further competition between Europe and other regions for gas and for LNG. And this is just looking at the impact of all of that on the supply picture. In terms of domestic production, we expect European gas production to increase by around 3% year on year. This will be mainly driven by higher output in Norway and the United Kingdom, where the maintenance season is expected to be less heavy than in 2021. But I think that here again, the two main moving parts will be Russian piped gas supply and LNG. For Russian piped gas supply, considering the Q1 dynamics, but also looking at the booked and available transport capacity to Europe, we foresee that Russian piped gas supplies will decline by approximately 17% year on year in 2022. And this will create additional marketing opportunities for other suppliers. In terms of pipeline suppliers, we see that the picture is a bit varied, with higher Azeri pipelines compensated down by potentially lower North African supplies, although this is an assumption which might be revised upwards in light of the recent ENI Sonatrach announcement. But as mentioned, it will be really LNG which will compensate for the lower Russian piped gas deliveries. Altogether, we expect that LNG inflows into Europe will increase by approximately 25 BCM and will reach a record level in 2022. So I think that one last point we would like to note is that amidst the energy crisis, which has been triggered by Russia's invasion of Ukraine, the International Energy Agency has developed two 10-point plans. One, to reduce the European Union's reliance on Russian natural gas, and one 10-point plan to reduce oil use in developed economies. This slide gives a brief overview of the 10-point plan to reduce the European Union's reliance on Russian gas. Altogether, we foresee that it would be possible to reduce Russian imports by about 1/3 or 50 BCM within a period of 1 year. And this would necessitate, of course, both supply and demand side measures. On the supply side, it would lead to a strong inflow of LNG, but also require stronger piped imports. But I think what is quite crucial here is also that we also foresee in the 10-point plan not to sign or not to renew long-term supply contracts with Gazprom to wean off this dependence through the medium term. But what is also key is to scale up the demand side measures, which include a better utilization of low carbon power generation in Europe, including nuclear and biomass. It includes also a more rapid deployment of renewable energy generation and a more rapid deployment of heat pumps, energy efficiency, and as well as temperature control. So just one observation maybe is that we see a very strong dynamics happening on the supply side. We mentioned that there is a record of energy flowing into Europe, that there are new agreements reached with traditional non-Russian pipe suppliers to increase deliveries into Europe. And this is, of course, extremely important. But in order to reduce the reliance on Russian gas imports, we also need to scale up the efforts made on the demand side. And this is something we need to do as soon as possible. And with that, I would like to give back the floor to my colleague, Jean-Baptiste. Thank you for your attention.
Thanks. So now to conclude this presentation, a few words on the outcomes of the current situation, what we see and expect for the rest of the year. So as Gege pointed out, the European market and dynamics shifting away from Russian gas has some very strong impact on the reallocation of flows on the global LNG trade. What we do expect for this year compared to what we've seen in the previous years is not a very strong increase in terms of LNG development. We're talking about something like 30 billion cubic meters, a bit less than that, of additional export capacity being commissioned this year. This mainly comes from the United States. We have a new train at Sabine Pass being commissioned, also the ramping up of Calcasieu Pass, which is a new greenfield project. As you can see at the right-hand side of the figure, it roughly accounts for more than 2/3 of additional capacity being commissioned this year. Of course, we still have some extended outages in existing facilities. We hope that those will progressively return to the market. Some of them are technical and with a known date to full return. Some of them are more elusive because they're linked to feed gas availability, and there the question mark remains. But what really matters on the demand side is that what Gergely showed you on the European balance translates into a 25 billion cubic meters of additional LNG flows to Europe, which, as you can see, accounts for the vast majority of what the market can deliver in terms of new capacity for this year. So our expectation is that, of course, Europe will drive the LNG market moves for this year. It's definitely the premium market, taking it away from Asia. This is something that we have seen since the beginning of the heating season, with high and volatile European prices driving Asian spot prices. We do see also some room for increase in Asia compared to last year, mainly in China, although the Chinese growth is less solid and less stable than what we've seen in the past, with certain questions on on its longer term direction and affordability. India and rest of Asia is also factored in, but with smaller volumes. There's a negative contribution coming from the rest of the world. It's mainly owes to the fact that Central and Latin America is expected to require less LNG than last year because of the exceptional situation of drafts that we've seen last year. But this is also clearly a limitation that will cap emerging markets additional access to LNG, both the physical limits of the market and also the very high price levels that we're seeing as of today. So this is really one of the main drivers that we see for this year, a strong push of European LNG imports that will drive the LNG market. Broader repercussions of the situation. If we move to the next slide. Thanks. So the broader repercussions are on the demand side. So on this figure, you have year-on-year growth as we saw it in the previous edition of the quarterly gas market report, which is the light blue, and compared to how we see it from the latest edition that was published a couple of days ago in dark blue. So for those who remember the previous edition of the report and the same discussion we had with our friends from CP and II 3 months ago, our expectation at the beginning of the year, back in January, was to have around 1% year-on-year growth for 2022, which was already down compared to 4.5% last year, explained by the fact that recovery was slowing down. We had this one-off impact of the end of the lockdowns in 2021 compared to 2020. We also had this string of exceptional weather factors, and also, of course, also the impact of high prices. But the situation was still positive, about 40 billion cubic meters of additional demand compared to 2021. The situation as we see it today is going into negative territory. Not that much. We're not talking as something as of the magnitude of 2020, which was 75 BCM down compared to 2019, but still negative, about 10 BCM. So there is a 50 BCM difference compared to what we presented 3 months ago. And this really directly shows the impact of the invasion of Ukraine by Russia and the consequences in terms of tight market globally and Europe's diversification. So what are the impacts regionally? You see all the markets are impacted. Of course, the bulk of the impact is in 3 regions: Europe and Eurasia, mainly in Russia in terms of demand. We had already anticipated a negative growth this year, again, mainly because of those one-off impacts of 2021 in terms of post-lockdown recovery and weather-related factors. But of course, the impact of the high prices and tight supply issues and impact on the demand demand dynamics are affected in. The biggest impact in terms of volumes is coming from the Asia Pacific market. As you can see, we have almost halved the expected growth compared to what we were discussing 3 months ago. This is a combination of both direct and indirect impacts. Direct impacts, as I illustrated before, is a more strict access to additional LNG, which will cap the potential for additional growth, especially in price-sensitive markets in Asia, and also indirect impact throughout the channel of lower GDP growth and some potential for demand destruction and energy substitution when and where it is available. Other markets are also expected to be affected with a more limited impact so far. So if you look at Africa, Central and South America, and even North America, we do expect that particularly the price-sensitive segments of demand, mainly in industry, likely to be impacted, therefore causing lower demand growth expectations than what we had previously, even if those markets are mainly relying on their domestic supply to balance their demand. One last point I wanted to highlight with the next slide. Sorry if I end the presentation with further glimpse of doom being cast on the overall forecast, but what we've assessed so far is the direct consequences of the situation, mainly on the gas balance. So less access to LNG outside of Europe, more tightness, sustained risk of high prices, high volatility. But the crisis, the conflict in Ukraine is likely to trigger wider impacts, both on the global economy and also when we talk about gas. Of course, as IEA, we're focusing on the energy uses of gas, but gas also has non-energy uses. So those two factors are illustrated very briefly on the slide. You can see on the left the evolution of gas prices, something that you saw already. But the one we've added is urea. It's the green line. As you may know, 70% of the world's ammonia production comes from natural gas. And ammonia, among others, is the primary feedstock for all mineral fertilizers, mainly urea and all the derivative products. We are seeing since mid-2021 strong issues on fertilizers market and other urea and nitrogen fertilizer-based products due to the high level of gas prices, but also due to the fact that main producing and exporting countries such as China and Russia have curtailed their export capacity to keep buffer for their domestic markets. So we're now seeing issues in terms of the repercussions of natural gas, high prices and availability, not only into the energy sphere, but also in the wider sphere of chemicals and by extension of food and crop availability for the next crop seasons. Second impact, looking more globally at the commodity prices, and this is something that Luca highlighted in its introduction. Higher inflation is mainly channeled through commodity prices. Of course, energy has been at the core of this run-up of inflation, and you can see on the right the energy price index, which has jumped by over 40 points in between February and March as a result of the invasion of Ukraine. But all the other commodity prices have been dragged by the cycle, whether talking about food, raw materials, or base materials. So the direct impacts that we've tried to assess through the presentation are the ones we can start to see. The indirect impacts, still something remain to be seen. thanks everyone for your attention, and thanks again to our host for having us. And more than happy to keep the discussion going in the Q&A.
Thank you very much, Gergely and Jean-Baptiste for this presentation. I needed to take a deep breath after your last slide and outlook on what the impact would be. But we have quite a few questions. Maybe on your last remarks, and I summarize some of the questions. We saw in the beginning of your presentation, we saw that American gas prices are increasing to levels that we haven't seen until the shale revolution started, which is quite high. I still remember a discussion in Congress about exporting LNG, that if the $6 per MBTU mark was hit, that they would discuss export facilities. So if And you saw in the business literature over the weekend, you already saw some musings about maybe thinking about an export ban. So how reliable is the US now as this very important supplier to markets both in Asia and in Europe to make sure that there is availability, even though the markets are tight? But with reduced American supplies, that would be even tighter.
Thanks, Kobe. That's a very, very good, very tough question to answer. I think that in terms of reliability, the US has shown so far that it is providing both volumes and flexibility. As you know, the US is a unique model in terms of LNG. It's not dedicated supply like we have in all other projects throughout the world. This is sourced from the US market. So hence raising this potential issue of competition in between domestic market and export market. But the US market rise in prices is not directly driven by the export and by the crisis situation in Europe. It's a combination of factors, both domestic and also, of course, this increase in export volumes. One of the concerns that's been voiced in the U.S. industry is the continued financial guidance and strong discipline that most of the E&P players in both oil and gas have been applying since the beginning of the pandemic. And in spite of the very positive financial returns that we have seen for 2021 from those companies, they have kept the guidance so far in their Q4 earnings calls and 2021 calls. So we'll see if with the Q1 calls we have different views. But for the time being, it's a question of supply and demand. And there is still some uncertainty if there is a short-term benefit to make, but what lies beyond the short term? If you commit to an E&P project, especially for a dry gas project, it's been very difficult. You mentioned the beginning of the shale revolution. It's been very difficult for pure gas players to break even. And since the beginning of the shale gas revolution, most of the break even was coming from the liquids. So investing today in a situation where there is, I would say, to be the least, high uncertainty on the medium to long-term viability of your projects is something to put in the balance.
Well, thank you very much. Well, maybe if I summarize some of the questions, because I have quite a few, it's on the storage levels in Europe. What you showed in the slide was the BCMs we needed to fill up the storages to 80 or 90%. What it didn't show is how empty the storages were. So what is the additional demand just to fill up the storages? Because Luca alluded to saying it, yeah, okay, from a European consumer perspective, it is very wise to do this. But to me, I mean, I'm old. So for me, it rings a little bit back when we had earlier crises that when you increase your your storages in a price of tightness, you actually add to the pressure in the market. So of course, there is what is the wisdom here, and then at the same time, what you show is that perhaps countries with less purchasing power are being pushed out of the market, so that the European issues are being exported to other countries. Could you give us a little bit more so that we understand the storage situation? Because Luca said that it was low because of Gazprom not filling up, but I have a feeling that also others didn't really fill up because of the higher prices in the summer. So it's not just Gazprom, but also others didn't fill up.
Thank you, Kobe. I think that's a key question and a key question for the coming months ahead of us. Now, the first part of the question, why we had low storages, I think there's two components here. One is that, again, just coming back to the facts, at the beginning of the 2021-22 heating season, European storages had been filled at 77%. This is well below the historic averages. And we see that, you know, the Gazprom storages have been filled at just 25% of their working storage capacities. And as such, the Gazprom portfolio of gas storages have contributed to about half of the European storage deficits. So that's pretty big contribution from just one market player. So I think that this is not something to be ignored. The second component is that there have been, of course, a situation of very tight summer-winter spreads, and as such, in some marketplaces where, you know, the regulation is rather loose or have been loose at the time, there haven't been a strong incentive to push more gas into storage. Now, again, this is, I think, a contributing factor, but if the Gazprom storages would have been filled to an adequate level at the time, I think that we would have been in a much more comfortable situation starting from the beginning of the heating season. I think that the second question is about the cost of filling up storages. I think that there is a general concept that the cost of storages, the cost of filling up storages equates, you know, how much gas you need to put into storages, and you multiply this by the prevailing market prices. I think that the cost of the storage filling should be rather looking at the differential between the summer and the winter contracts along the forward curve. And when you look at this way, the cost of gas storage filling is much less. Now, this being said, it is not looking very attractive because the summer-winter spreads this year have been largely negative in Q1. But I think this is why there's a need for some regulatory incentives to fill in the storages, because then, you know, we don't want to have a situation when we start to calculating in January 2023 the cost of not filling gas storages, because I think that cost could be much more serious and greater than the calculations we are doing at the moment. So I think that we need to look at what would be the cost of not filling storages to an adequate level, which I believe would have quite serious consequences potentially.
Okay, thank you for that answer. Quite a few of the questions are obviously about the LNG market and the competition between Asian buyers and European buyers. Something I think we've noticed is that European buyers are not really at the forefront or at the front of the line to conclude long-term LNG import contracts. And I don't know whether I've missed something. so do you expect that that more is there an availability for European long-term contract LNG buying? And the second part of the question is, if we look at the balance in the LNG market, which you presented as fairly tight, is Russian LNG part of the LNG supply, or have you taken that out of the equation when it comes to European LNG imports?
Well, first on the on Europe's longer-term ability to contract LNG volumes, I think that we have to bear in mind that Europe has its own path towards decarbonization. It wants to phase out fossil fuel reliance, including natural gas. So this is, and the objective of Repower EU is to reduce dependency on one particular supplier, but within the framework of Fit for 55 and net zero emission in the longer term. So the procurement is not binary. It's only short term versus 20 years plus. We've seen emerging over the past decade 5 to 10 and even below 5-year procurement capability. But this, of course, banks on existing capacity. Having 5-year contracts is not sufficient to trigger final investment decisions for new projects to happen. So there has to be some engineering in between the primary buyers and the final buyers, who will be the European utilities, to make this happen, ensure that we bridge the gap in between this primary market and that final market. So far, it has been the so-called global portfolio players, the big oil and gas companies, and big utilities who have been bridging the gap. They are now in a position which is, I guess, financially comfortable, because they have their open position, which are being met by very high spot prices. But before the tight situation that we're seeing, those companies were facing quite a commensurate risk because of those open positions. So it's a bit difficult to say whether if these companies are likely to take further risk into committing in more long-term position with open or only short to medium-term position matching for the European market, and what will happen beyond that. I think it remains an open question whether if this additional needs for the short to medium-term market will convert into longer-term committing decision for new projects. What is certain is, as you look at what is foreseeable for the next 5 years, we're not seeing a huge increase in capacity, apart from the expansion of Qatar, but it's a couple of years away from now. So the next 2 years would be more or less what we see this year, about 30 BCM of new LNG capacity. Sorry. Sorry for that long answer. I forgot the second part of the question.
No, that's okay. It's just that I think you already answered it, that the uncertainty for investors on this move, how long-lasting it is. And of course, as time passes, things are perhaps getting a little bit clearer, but not clear enough for making these very large investments that would take your facilities into the 2040s, when the discussion is going the different way. Maybe if I just add on as the delivery of this additional LNG, under what circumstances, there is quite a bit of uncertainty, as you say. But still, I'm interested in these other markets that are featured, whether that have to move with the market. Are these mainly the emerging markets that had entered the gas import business in between 2014 and 2020, so that so their coal consumption would be lower in terms of urban areas in emerging markets? And are they being pushed out of the market at the moment? So what is the situation in these non-Asia, non-European LNG markets? How are they coping?
Well, there are basically two of them. The Latin American markets, which are heavily weather dependent. And as we said previously, I think that Brazil, which has been at the bulk of the increase for Latin American demand last year, is expected to decline because of the improvement in the hydro situation. For other markets, which are much more limited in terms of volumes, and also a very strong price sensitivity component, thinking in particular of Central America and the Caribbean, where gas is exclusively used for power generation to displace liquids. And we have seen already some, I wouldn't say decline, but stagnation in terms of LNG intake from those countries, especially those who are not fully covered by long-term contracts to buy on the short-term markets. The other one is even lesser importance of today in terms of volumes, but has a lot of promises. It's the African market, and particularly sub-Saharan African market, where there is currently no import, but a couple of facilities have been deployed last year in Ghana, in Senegal, and South Africa was also expecting to deploy 2 FSRUs. And in those markets, it's also a question of displacing liquid fuel for power generation. And as far as both Ghana and Senegal are concerned, those floating units have been commissioned a year ago, and they have not received a single cargo since then because of the tension on the market. So it's a question for those countries, which is not a volumetric issue for the whole market. It's a clear question in terms of how it will impact their own energy transition scheme, using gas as a stepping stone to decarbonize and move to less carbon intensive solutions.
Thank you for this answer. I think we're moving towards the last question, so I've really broadly summarized it. But one of the discussions in Europe has been the fact that Southern Europe has, and particularly Spain, has significant LNG import facilities, and that weren't fully utilized. And then there is a very weak link to feed gas into the system of other European countries. So it's barely integrated with a very weak gas link. Do you expect the European Commission to, as part of its big planning, that for instance, a link between Spain and France will be strengthened, and perhaps other reverse flow issues, because the design of the European system is very east-west, and maybe we should move more towards west-east and south-north and north-south than we have currently. So is this what we're discussing today, is that sufficient to actually make these plans on paper workable in the short to medium term? To pivot away from Russian imports?
No, I guess again, maybe to mention that Spain has indeed over 60 BCM of LNG import capability, and the link towards France is almost just a tenth of it. It is around 7 BCM per year. So, but I think that there's obviously a question around how fit the European gas infrastructure is to this new market context, where probably the flows will be quite different, and we see a flurry of growing interest towards floating to FSRUs, to floating LNG terminals. We see a lot of discussion around what interconnectors should be implemented. At the very end of the day, it will be always a question of market interest by the market participants, and the supportive environment which is created by the member states, and to some extent by the European Union. So, but obviously, I think this is without a question, we will see some changes in the European infrastructure setup. This is just a natural consequence of the new market reality post February 2022. And we obviously hear those discussions around the France-Spain interconnector. We also hear about the possibility to revitalize one of the energy terminals in Spain, which has been mothballed since over a decade. So there's a lot of discussion, but again, at the end of the day, this should be a decision made by the market participants. And as such, we are not going to comment precisely on this project.
No, I understand. I was thinking maybe we could do some reverse engineering by in the future. You see that there's more interconnection capacity between France and Spain based on the hydrogen plants. So maybe we can build hydrogen pipelines that can also take methane. I mean, it's just, these are just semantics to some extent. But it is interesting to think that if you look at the big numbers, that maybe certain segments of the European market might actually not be able to be reached with these flows coming from different directions, which is a discussion that might maybe upend some of the plans to move away. You had indicated you guys have another meeting in a few minutes, and we have a lot of questions. We have recorded this meeting, and also with the questions. Well, perhaps with most of the questions, I think in general we dealt with, not with the really precise ones, but maybe some of the people I see by their names can reach out to you, I guess, either through LinkedIn, Twitter, or whatever, for you to answer a few more questions in the next few days, because I would like to let you go and make sure that you are well prepared for your next meeting. I want to thank you very, very much for doing this presentation, also by giving us this look on the impact of gas prices, not just on industry, which I thought was a very worrisome slide, but also on other prices, and that we are only in the beginning of understanding what the impact of what is going on is going to be on other sectors. We had a very interesting question, because part, of course, of the planning is to speed up the energy transition, but also prices of materials that we need in order to build up these capacities are also up. So I think slowly, maybe, of course, people in the energy industry understand how complex everything works together, but we have perhaps not communicated this enough to society for them to understand that it's that everything basically is connected together in terms of making these steps. I really hope that by June we will know and understand a little bit more again. And we want to thank you for all your analytic work that you do in the meantime for us. And we greatly welcome you to repeat this briefing of us on what is going on. We're all trying to get as much information as we can, but your quarterlies are really helpful in the current situation for us to get a sense of where we are and what might be ahead of us. So Jean-Baptiste and Gergely, really thank you a lot. Luca, thank you again for collaborating on hosting this for everyone, and I wish you a nice day, and hopefully see you soon again. Bye-bye.